I would ask unanimous consent that further proceedings then under the quorum call be dispensed with.
Without objection, so ordered.
Mr. President, yesterday the Senate Permanent Subcommittee on Investigations, which I chair, held the fourth in our series of hearings to explore some of the causes and consequences of the financial crisis. These hearings are the culmination of nearly a year and a half of investigation. The freeze, and Mr. President, if I could yield myself 10 minutes.
Without objection, so ordered.
The freezing of financial markets and the collapse of financial institutions that sparked our investigation are not just a matter of numbers on a balance sheet. These are numbers reflecting millions of Americans who've lost their jobs, lost their homes, lost their businesses in a recession that the housing crisis sparked, and this has become now the worst economic decline since the Great Depression. So behind these numbers are American families who are still suffering the effects of a man-made economic catastrophe. Our goal has been to construct a record of the facts in order to try to deepen understanding of what went wrong, to inform a legislative debate about the need for financial reform, and to provide a foundation for building better defenses to protect Main Street from Wall Street. Our first hearing 3-4 weeks ago dealt with the impact of high-risk mortgage lending, focused on a case study, as our committee does, this time of the Washington Mutual Bank, known as WAMU, a thrift whose leaders embarked on a reckless strategy to pursue higher profits by emphasizing high-risk loans. Now, these were not loans that were likely to fail. These loans also created real hardships for the borrowers as well as a risk for the bank itself. What happened was there was basically a conveyor belt which was built that fed toxic, bad, reckless mortgages based on these loans into a financial system, just like a polluter dumps poison into a river. This was a commercial stream that these mortgages were dumped into. The package that they came downstream in was a mortgage-backed security that WAMU sold to get the enormous risk of these mortgages off its own books and shifted to somebody else. The second hearing examined how federal regulators at the Office of Thrift Supervision watched, observed WAMU, saw the problems year after year, and did nothing to stop them. Supervision that should have been conducted at arm's length was instead done arm in arm, supervising the regulator supposed to supervise, as part of its name, arm in arm with the bank that it was supposed to be regulating. Third hearing dealt with credit rating agencies. These are specific case studies of Standard & Poor's and Moody's, the nation's two largest credit raters. And while WAMU and other lenders, WAMU wasn't alone by a long shot, dumped these bad loans, regulators failed to stop the behavior. Credit rating agencies were assuring everybody that that poisoned water was safe to drink. AAA ratings were slapped on bottles of high-risk financial products. So that was the third hearing. We've got to do something about the inherent conflict of interest that is involved when credit rating agencies are paid by the people whose actual documents and whose transactions they're approving or not approving and putting labels of AAA, AA, and what have you on them. There's an inherent built-in conflict of interest. Yesterday's hearing explored the role of investment banks in the development of this crisis, and we focused on the activities during 2007 when that housing bubble burst of Goldman Sachs, that is one of the oldest firms on Wall Street. Goldman's documents made it very clear that it was betting against the housing market while it was aggressively selling investments in the housing market to its own clients. It was selling to clients high-risk, mortgage-backed securities and what they call CDOs and synthetic CDOs that it wanted to get off its books. They wanted to get securities off the books. They were selling them. They were reaching out with one hand to prospective buyers and saying, here, With the other hand, they were betting against those same securities. The bottom line is that what we have discovered in this investigation and saw yesterday at our hearing, that there's a conflict of interest too often between what's in Goldman's interest, what's good for their bottom line, and what is in its client's interest. Now, these are deeply troubling findings. There not only was a collapse of a housing market, there was a collapse of values. And extreme greed is the thread that connects these events, starting with those mortgages that were sold out there in the state of Washington by a Washington Mutual Bank. Extreme greed that indeed involved the people who were supposed to be doing the credit rating being paid and doing a lousy job of rating the financial instruments that pension funds and others are buying, and greed that, of course, was involved in Wall Street, selling, securitizing financial instruments which they believed were not good. They were betting against at the same time their clients and customers were being sold. So what we've got to do is build defenses against these kind of excesses. And I think most of us that are at the hearing, most of us Democratic or Republican senators who are on my permanent subcommittee on investigations saw the problems right from the beginning, where the upstream where the mortgages were created, downstream where they landed in Wall Street securities. We see the problems, Americans see the problems. Americans and we cannot understand how a company can design and build a product